Okay, great. And we are live. So welcome everyone. Thanks for joining us today. My name's Lee Perry and I'm in the marketing team here at CoinTree. With us today is Rush Gold co-founder and head of business development, Mark Pey. Thanks for joining us, Mark.
Yeah, thanks for having me, Lee.
Earlier this year, CoinTree partnered with Rush Gold, which was a really exciting new feature that we added into the platform. But it was really about adding gold bullion investing as an option to the trading platform and helping our customers diversify their portfolios. But what we're really here to talk about is obviously what role gold actually plays in a diversified portfolio and how it gets allocated in those portfolios as well. So before we jump into that, we'd love to hear a little bit more and maybe give the audience a little bit of background around yourself and obviously Rush Gold. So I'll hand over to you, Mark, to give us a bit of an intro.
Sure. So I was born in a log cabin in the late 1800s. I actually moved to Australia about 15 years ago to run Microsoft's financial services practice, and then am one of the founders of Rush Gold. So my background is technology and financial services. Started my career as a banker, mostly with JP Morgan. So really tried to understand the nature of markets and finance investment. And then as you dig in, you start to think about things like currencies. And so I know people that invest in cryptocurrencies, and I'm one of them. Are interested in kind of that currency layer and what is the nature of money and what are the different forms of money that you can own and you can hold. So we founded Rush Gold to make it incredibly simple for both our customers and our partners like CoinTree to own physical gold metal. So to be the outright individual owners of gold metal. There are a number of ways to own gold in the world. You can buy coins, you can buy, funds. Really, the form of gold ownership that we're talking about with Rush Gold and through the CoinTree partnership is the form of gold that has lasted, 3,000 years, which is to be the outright owner of physical metal. We were the kind of investors that wanted to take the bar home and stick it under the bed. But then we started thinking about it. Well, then it's not liquid and it's not available. So as long as you have confidence that the gold is there and that it's secure, we think that the partnership with CoinTree is a great way, to own physical metal.
Yeah, exciting. And I mean, gold has obviously got a very long history now. Can you tell us a little bit about about the background of gold and how it's like grown as an investment asset?
Yeah, sure. So, I think mankind from the very beginning needed an asset where they could trade easily. So they didn't want to take a sheep to market to trade with the guy who had soap. So they needed something in between, and that's money. And then you have to ask, well, what's the nature of money and what should be the really good forms of money? And through millions and millions of decisions by people over the ages, they kind of settled on this incredibly rare, physically rare asset that is also immutable. In other words, it doesn't combine with other elements. You can bury it underground and dig it up 1,000 years later, and it still shines. And so it became, as people know, the gold standard. Really, there are a couple of things that I think are important for people to think about now. One of them is the saying that gold tells the truth. Banks and investment companies, investment advisors, they may or may not want people to know something like the truth. Now, Bitcoin and these things provide immutability. That's a form of truth. Gold is kind of a physical counterpart to that. Now, who owns gold? Almost every government in the world, all the central banks, the biggest investors in the world, the ultra high net worth customers, all the way the funds down to retail mom and pop. It's housewives in India that buy these big gold necklaces as a form of savings. Because they know that that's a store of wealth. Now in India, as an example, they have the local currency, which is the rupee, and it's not necessarily reliable. It steadily over time just loses its value against goods and services. So that's why people in that case opt for gold as a form of savings. Yeah. So it has a huge history. Now, a lot of people don't also know that gold trades almost as much as the Standard & Poor's 500 every day. So that means all the shares on the U.S. stock market, S&P 500, gold trading volumes are almost as much as that, which means it's an incredibly deep market, incredibly liquid. Yeah. And so sometimes what happens when you have the beginning of a crisis, the price of gold dips a little bit because it's so liquid. The investor can receive cash for it very easily and then go pay off their other investments. But certainly over time, I mean, that's what happened at the start of the GFC. It dipped a little bit, and then over the next 18 months, it was up, 50, 60%. So that's a little bit of background about the yellow metal.
Yeah, interesting. And I think earlier you were talking about obviously there are certain areas or countries around the globe who have a lot more of an appetite for gold as well.
Yeah. Yeah, that's right. So we have customers in 15 countries, and it's very interesting because when the price of gold is moving up, 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 we find our customers in the U.S. and Australia tend to buy more. When the price of gold is declining in a downtrend, we find our customers in Asia tend to buy more, and it has to do with the different psychology they have. They have what you'd have to say are less reliable local currencies. So in the Asian financial crisis, for example, if you were in South Korea or Thailand or Philippines, a bunch of other countries, you lost 50% in a week, right? Just by holding on to your national money. And so in the West, we really haven't had a problem holding on to our national money. Australia's got a strong currency. U.S. has got a strong currency. Really, we see with the current crisis, though, is that currency crisis is creeping up from places like Turkey, places like Venezuela, to the mainstream countries. I mean, overnight, we had an unbelievable crisis in the British pound. Well, the British pound used to be the currency that ruled the seas. Yeah, so I think as people, start to get up kind of the knowledge curve, a little bit of, monetary history and financial history, I think it's more and more the case that they say, look, I should have some of my assets outside of the banking system and outside of the currency system. And both crypto and gold are designed to do exactly that.
Mm. Yeah. And I think one of the biggest things that we're seeing in the markets right now, obviously, is an ongoing rise in monetary policy and inflation increasing. Obviously, this has happened in the past as well. How has gold performed, and is there anything that we can look to that might inform how it's going to perform in the future?
Yeah, so let's recall what they told us about inflation. A year ago, they said it doesn't exist. Then the second thing they said is that it's transitory. It'll be over soon. And so now, the Reserve Bank has told us it's 6% annual. In the U.S., it's 9% already. And in the U.K., I think it was 18%. Germany, it's over 50%. And so, I think you have to, you do have to be a little bit of a student of history. So the fear that we have is that we are entering what you might call a stagflationary era. And all that means is a period of high inflation with low economic growth. So the last time we had stagflation was in the 1970s. And gold at that time went from $35 to $850. So I think people forget that gold can be very explosive on the upside when you have the conditions. Now, I wouldn't, make price predictions like that, but I think this is a time, the last 12 years of kind of central bank fuel bull markets has been a time when everybody's only thinking about growth. But now is the part of the cycle where you have to think about capital preservation. And so, I went to Woolies the other day and I bought a chicken, an avocado, and a loaf of bread, and it was $29. Yeah? So the currency that we hold, that we transact with every day, the Australian dollar, is losing its value out from under us. And we say losing its value, so you see all these indicators, the stock market or the other currencies. There are ways to measure it. The important thing is to measure it against the things you need, the food, the energy, the electricity, petrol, all these things that you must have in your life. The currency is losing value against those. And so, in a case like that, we haven't had to face this problem for many years. But now it feels like, we do have to. And so, an inflation rate of 7%, let's call it, that's already a disaster. I think your buying power is cut in half in 5 or 6 years at that pace. So Reserve Bank knows this and has been raising interest rates. So we think that it is a bit of a classic stagflationary setup. And so, the people who know the most about money in the whole world, the central banks, the big hedge funds, and the big, ultra high net worth people and the family offices, they're all upping their allocations to gold in this environment.
Yeah. And so, I mean, gold obviously forms a part of a investment portfolio. Like, is there an allocation that you would usually see in people's portfolios, especially in times of stagflation?
Yeah, there's probably a bit of a longer answer to that. So the classic investment mix is 60-40, equities and growth and fixed income and real estate. Yeah, so that's 60-40 portfolio. And that's been the go-to answer for many years. And it's done incredibly well for many years. We're in a very different environment now, where the 60-40 portfolio, both sides of that, got absolutely clobbered in the first part of this year. And that's for the first time, in 30 years. So there was some really good academic work that was done by Oxford Economics, and it asked the question, to the regular 60-40 portfolio, what percentage of gold would you allocate to it? And there was an optimal level, which was between 10 and 15%. And so what that did is it reduced the risk of the portfolio, the volatility risk of the portfolio, while it increased the return of the portfolio. So it was a win on both sides. Now, I think crypto, presents a different option for people. There's been obviously incredible capital growth in crypto world. And there's also been, we're in the middle of a crypto winter. I don't know, beginning, middle, or end, but it is a crypto winter right now. So that presents, a capital allocation, decision for people. I think crypto is super hard to value, I can recall. I'll just tell a quick story. So I went to my first Bitcoin conference in 2013 in Silicon Valley. Of course, I should have bought everything inside at the time, but I did buy some Bitcoin at $140 and I sold it at $800. I thought I was an absolute genius.
Shocking now,
right? And so I know there's plenty of stories like that out in the world, but I think the point is that you want to think about what kind of assets you want to own, and then you want to set about acquiring those over a period of time. And those assets could be crypto, it could be gold, it could be equities, whatever it might be, real estate. But you really want to set about acquiring those and pay less attention to price at the time. I think Warren Buffett said something really smart. I'm not really a favor of a lot of the sort of dinosaur investors, but I think he said something really smart. And I think it's something people can think about, is that, he's talking about the difference between price and value. And in the short run, the market is a voting machine. In the long run, it's a weighing machine. And so what he means by that is, in the short run, the price can fluctuate and people have an argument about how much is it worth, the buyer and the seller. But in the long run, you weigh what is the value of the thing that you have. Is it bullion? Is it, a company that's making a lot of money? Is it a crypto that is getting a lot of usage? Or is it a DAO that's earning a lot of fees, things like this. So it's tempting to say, apply some percentages to what you want to move your portfolio to. If it's 10%, 15% in gold bullion, just stick with that plan and then check the price in a year's time. Yeah, so you could do the same thing with your crypto. I think it's a real danger for people to check their portfolio every day and say, based on some short-term movement, say, oh, my strategy's not working. Well, you have to give your strategy a little bit of time to work.
Yeah, great. And we've got a question here from John, which is just, hey, Mark, what do you think of gold's prices in the next 6 months when the US dollar keeps on increasing?
Yeah, so gold and the U.S. dollar are kind of arch enemies. I'm probably not telling this customer anything new. They're kind of arch enemies. I think what is additionally interesting is that you look at gold in other currencies. So we hear the headline price of gold, oh, gold is down. Well, they're talking about gold in U.S. dollars. You look in the last 12 months, gold is up, I've got it written down, 5.68% in Australia. Yeah. Gold is up 18% in the UK. Gold is up 25% in Japan. Gold is up 111% in Turkey. Yeah, so gold trades all over the world. So I think the fixation on the US dollar price of gold is not necessarily the healthy one. Now we're entering a new phase of crisis and war and inflation and civil unrest. And in cases like that, people do tend to find haven in the US dollar. Now, the problem is that as the dollar gets higher and higher and higher, it makes it harder and harder and harder for most of the countries of the world to even survive and buy oil and buy food and things like this. So there's going to be a limit to the dollar's run. Really, that saying, gold tells the truth, I think is a good one, because, it doesn't care which central bank program or quantitative easing, or doesn't care about any of that stuff. It's just an asset that is there to protect your wealth and to be there when it's really a worst case scenario kind of asset. So I don't know if that really addresses the question. Right in terms of pegging a price of gold, if people want to do a little bit more technical analysis, they'll see that gold correlates pretty consistently with oil, with energy. And we've had a decline in the price of oil over the last sort of 6 months here, but the supply situation is really terrible for energy and for oil, and we expect there to be a big rally. All the Wall Street firms expect a big rally in oil next year, and we think gold will follow suit.
Yeah. Interesting. I mean, that was going to run into my next question, which was really about gazing into the future. I mean, if you could gaze into the future, what role do you think gold would play in, in investment portfolios?
Yeah, I guess I'd say the role that it already plays, right? So the central banks of the world trade tens and tens of tons of gold every day. And so it's not sort of advertised. They actually keep it all pretty tightly concealed. They don't want to reveal who owns how much or how much they're moving. So gold has a huge role in financial services world already. You think about when we had the true gold standard, you then had a stable, platform from which you could do things like calculate investment hurdle rates. You could think about, how much am I earning, right? If you're on this treadmill where you earn this number of Australian dollars, but there's a slipping in value 6 or 8% a year, it's an inherently unstable system. Yeah. So I think a lot of people hoped that Bitcoin could be, a global standard of wealth. I think, people have launched a lot of different cryptocurrencies with the intention that it substitutes, for money. I think, JP Morgan is widely quoted as gold is money. And actually the real quote is money is gold. Everything else is credit. So you sort of have to look at what people do rather than what they say. And governments will say, well, gold's not that important. I think, Ben Bernanke famously said, oh, it's just a barbarous relic or whatever. You have to look at what they do rather than what they say. And what they do is they all own large quantities of it, and they trade it very, very frequently every day. Yeah.
Yeah, it was quite interesting when you said around the S&P 500, gold trading more than the S&P 500, because it is something that you don't typically talk about or see that often, but to actually consider it in that context, it's quite eye-opening.
Yeah. Yeah, that's right. And so gold has been called kryptonite for bankers. And the reason is that they really can't make a lot of money on it. And so they'd much rather have the financial press and everybody talking about, this share or this bond or this, financial offer. So it kind of gets, I would say, somewhat ignored or just pushed to the background by the financial press, and you just don't hear that much about it. But in the meantime, you look at the volumes, you look at the filings by the countries and the Bank of International Settlements, there's enormous volumes of gold that are traded every day. When you have an asset that is traded that deeply and that widely, so traded all over the world in large amounts, what you have is you have certainty that if you need cash, you can get it. And that, I just don't think that, you look at that. And so an asset, you can have a very thinly traded junior gold mining stock, doesn't trade that much. If you have to get out, it takes you a while to get your cash. And there's a discount value for that. Because gold is instant, global, super deep markets, it has a liquidity value. Sometimes we see in the beginning of a crisis, I think, as I mentioned earlier, that gold sells off a little bit. That's because people know that they can get cash for it overnight. It works really just like cash. And then, really typically you then see rallies, further on. Now, we measure gold value in currencies, in different currencies. How many, US dollars per ounce, how many Australian dollars buys you an ounce? I guess I'd suggest we might measure it in avocados or in, electricity bills, because really people want money not to have money. They want money because they want things. They want shoes. They want a trip to Bali. And, so those are the things. I mean, it's interesting that people kind of have to reconceive, what money is and how it's used and what it's for. Crypto, I think, is a super interesting set of experiments to try to have a different answer to that. And we fully support that. And so crypto is independent of the world banking and currency systems. And we think that's a major source of the value there, is that, no matter what happens overnight in England because of their government policies, crypto, is there independent of that. Maybe take a second and talk about the difference between Bitcoin and gold, because I think they're quite different and they're really for different purposes. So Bitcoin, I think you have to say, is for speculation. It's been a tremendous place to, grow capital over time. Gold is about capital preservation. So you would see, for example, in the last 12 months, the Bitcoin price has suffered quite a bit. Gold price, I think, the last 12 months is up 5%. So they sort of fill different roles in an investment portfolio. The other thing that people, I think the biggest investors use gold for, is as kind of an insurance policy. If everything really does go to hell in a handbasket, you want to be sure if your house burns down that the foundation and, the insurance policy is still there. And that's what people use gold for, and what they've always used gold for.
Yeah, interesting. And we've got another question here. And for those that are watching, feel free to pop any other questions that you have in the public chat, which will be available to you. But a question from Daniel R. Is, I guess, about buying gold. So when you're thinking about investing in gold, are we thinking about investing in physical gold, or is it buying shares in gold mining companies, or even gold ETFs? Obviously, through the Cointree platform and Roche Gold, you can buy direct access to title of gold. But what does that look like?
Yeah, sure. So, be aware that when you have a gold ETF, you're buying a share. And the shares can be affected with share market volatility. You also have to read really closely the prospectus for a gold ETF, because you may or may not be the owner of gold. It could be, the gold is owned by the fund. It could be the gold is owned, is held by a custodian or a sub-custodian. All of these different financial providers that have to perform in order for you to receive the gold, right? And so what you're really investing is the price of gold. And that's fine, and they're liquid and things like this. The thing I'd say by comparison to what we do is that the ETFs typically have pretty high, costs of ownership. And so they might charge you, 90 basis points or 150 basis points to own that fund for the course of a year. Well, we're really at a fraction of that. And in our case, through Cointree, you're the owner of physical gold metal. It's independently custodied by Brinks. It's insured for damage or theft by Lloyd's of London, audited by Bureau Veritas, and you're the outright individual owner of that metal. So even if something were to happen to Rush Gold, it's still your property. It's still protected under your property laws and consumer laws. So now, with regard to junior gold miners, it's not really a place to own gold. You don't go there, I think, because you want to own gold. You own there because you want to own shares of a company that will go up in value. And they can be absolutely explosive on the upside, but they can also really disappoint. So it's a much higher risk type of asset than owning physical bullion. There's the famous saying that a gold mine is a hole in the ground with a liar standing next to it. And you hate to say that, but because obviously some of the gold shares have done incredibly well over the years. Really, the trick has been choosing the right ones. And they have a whole additional set of risks attached to them: price risk, sovereign risk, company solvency risk. They may have great gold in the ground, but the cost to get it out are too high. There's a lot of different things. So those are sort of things on the spectrum, right? So junior gold miner, sure, you might have a percentage of your funds there. We think at the core of a portfolio, in that 15%, let's call it, maybe even more in this environment, that it's a capital preservation and it's a wealth preservation. The psychology in the last 12 years has been growth, and what's going up and everything going up and all this stuff. We're at a different part of the cycle here, where it's about, hey, I want to try to preserve what I've got. And investors all over the world, I think, are getting a real wake-up call this whole year in the NASDAQ down 30%, the bond market being absolutely clobbered. And so, property starting to really fall off here in Australia. Investors are focusing more on preserving what they've got here. I think that's true.
Yeah, interesting. Well, how quickly time flies, Mark. I can't believe we're almost at time already. I will just ask if there's any questions that anyone has. We've got a couple more minutes left for a quick Q&A. But beyond that, Mark, did you have any slides or anything that you wanted to share with those watching today?
There's a couple things, and the buttons have changed here. Show presentation. Let me see. I think if I can click over there, I just think maybe this very first one, if I can click on it here and see if it shows. Yeah. So this is, it takes a minute to get your head around this slide, but it's super important, and you can see it goes back, many decades. And so this is, we've called this kind of the rock, paper, scissors. At these peaks here is when, rock has done well. Yeah. So the oil crisis in 1972, the Gulf War, the GFC. At the bottom here is when paper has done well. So this is kind of the difference or the ratio between commodities, the GSCI, and the S&P 500. So S&P 500 obviously is paper and shares. And as people, lose, so they invest less in commodities and more in shares, you can see you got down to this dot-com bubble peak. Yeah. But then, you had this increase all the way up to the GFC, and people then again lost faith, in the physical assets. It looks like we're building a really huge bottom. The median of this to where paper assets and real assets like gold would be, let's call it fairly valued. It looks like we're making a really long-term trough here and headed up. And so you see that in the energy markets, you see it in the markets for things like lithium, you see it in all kinds of, it's kind of, we've gone through this last 12 years of central bank kind of inflated bubbles, and all the paper assets did really well, the bond market did really well, the stock market did really well. And now it's the turn of things like oil, like gold, like copper, like lithium, like food, like wheat, things like this. So these kind of secular trends, if you can get them, as your tailwind, then your portfolio will do fine. Yeah. I think that's kind of the one
Well, I think we've got 1 minute left, and I just want to throw to a question from Phil in our audience, who asks, what is your gold price prediction by 2025?
Yeah. So, I guess I'm not sure I'm going to answer that. And it's not because I think gold is going to be way down or way up, or, we could just say different things. I think people have to think about what is their financial objective. What is the purpose of the funds they're holding? Are they to use in a year or two? Are they to make sure they're there for, a big purchase in 10 years? Think about those things, and then make your plan for what percentage you think should be allocated to different investments, whether it's crypto or gold or shares or property, whatever it might be, and just stick to that. Yeah. There are predictions for gold that it's $10,000 an ounce. Again, I just point to stagflation in the 70s. It went from 35 to 850. Now, if you project that out, people have, would make enormous fortunes just by holding physical bullion. So we don't really make, just hard price calls beyond that. There's a lot of commenters that you can look to that, but we just think a really sensible approach is to make sure you own some. Yeah. Yeah.
Great. Well, it's been a pleasure interviewing you and hearing more about gold and learning more about gold. If people want to know anything more, where can they, or they want to connect with you after, where should they find you?
Yeah, look, I'll give my email address. It's mark.pey@rush.gold. My surname is spelled P-E-Y. Happy to chat with people, answer questions that they may have. I just think these are really tricky times out there. I think geopolitically, I think in the marketplace, I think, lots of things are changing around there. And that's one thing that people do love about gold is that it doesn't change. So people want to send me comments or questions. I'm happy to help out.
Amazing. Thank you, Mark. And for those watching, there will be some more information once this webinar ends, available on your screen if you'd like to find anything more.
Thank you, Lee.
Thanks, Mark.
All right.